Welcome back, Money in the Tank Potters. Episode 68. Joining us today, we're going to be just the two of us. Jolie's out, unfortunately. Usually the man is the one running the show, but we'll try and take over and give you a good episode. Today's episode is going to be largely focused on, yes, either do you believe in doom and gloom, or do you believe in positive market forces are stronger than doom and gloom out there? And so, bit of a recap about what's going on in the world, or people think is going on in the world, at least I should say. And then my and Arnie's view on kind of what we individually think. We've got some Rivkins, we've got some rapid fire news as well, and I'm sure we'll think of a 50-50 by the end of it.
That's it.
But without further ado, Brad Tabone, investor and just a startup guy.
Yeah.
And to my left.
Oh, yeah, to your left today, Arnie, the finance professional. And if you could please give us a like, comment, subscribe, click the bell. That's at Money in the Tank, YouTube, Instagram, Twitter, Facebook. Actually, not called Twitter. It's called X. X.com.
It's going to give it to you.
So, yeah, let's hit him with a Rivkins and then have a bit of a chat about where we think the market is going. So, interesting times.
Two illustrious beards as well, Arnie. I like to see it.
I think Jolie has one too at the moment. We've become the bearded pod.
I like it. We just got to change the name. So, Rivkins, a good company can be overpriced and a bad company can be underpriced. Thoughts, Arnie? Philosophical thoughts?
Yeah, he's 100% right. And I think that's the trick when you're not passive investing. When you're active investing, how to know when a good company is overpriced or a bad company is underpriced. Like you're looking at value. There are certain people, a particular niche of investor who wouldn't care if it's a good or a bad company, and if it's undervalued, they'd invest. But yeah, I guess like it's sort of like
you are not one of those people.
No, I'm not.
You are a value-based investor.
Well, I mean, a value-based investor might invest in a bad company if it's undervalued, if they see a short-term gain. I think.
Okay, I get what you're saying. Sorry.
So what I'm trying to say is like someone like a Buffett or a Munger nowadays, and over the last in recent times, always preach buy good companies when they're undervalued. Don't buy bad companies when they're undervalued or overvalued. But I know, like, if you think of someone like a Walter Schloss. Like he used to put his he puts a hierarchy, and the number one most important thing on his hierarchy is the company cheap. And he might buy a shit company if it's cheap enough, because even shit companies can revert to the mean. So I don't know, man, but like it's a highly debated topic, and I think it just makes sense to stick to the good companies because there's less risk and less chance that they're going to F you over.
Yeah.
What do you think?
Well, I try not to follow bad companies, but somehow I can find them. Anyway, look, yeah, I'm a value investor as well. While I don't mind investing in companies that are on the borderline where there's massive upside, for instance, and low downside, kind of, if you're looking at how much money can I lose versus how much money can I make if they do return to that kind of good company phase. If the bets there right enough, great. If you see some value in it and they're cheap, but usually, in my I guess experience, things are cheap for a reason with bad companies. The market has a way. The market has a way of generally being right when they're pricing bad companies. That's just what I've seen from the many bets that I've taken over 18 years, whatever it is. The market is at least, I reckon, 80-20 from my kind of what I've seen, where even if I can't work out why they're priced a certain way and they look amazing value and the rest of it, the market's turned out right where, within a couple of years, there was something operationally or something cost of goods or something debt-wise or something, just market has changed and competitors. There's been some force from somewhere that, I couldn't find that ultimately ended the company or, basically reduce it to a penny stock. So
I know we're spending a little bit longer than we normally would on a Rivkinism, but I like this one. You just touched on something which is like a famous adage in investing, like a famous little, I don't know what the right word for it is, but the quote is, if something is cheap, don't just buy, ask why. And a really good example of that right now, and possibly so something I'm invested in, general in nature,
general nature, disclosure,
yeah, do your own
all
due
that kind of
diligence.
stuff.
But like, I'm invested in Playboy. A lot of people would say that's a bad company, and for various reasons. So there's a moral and ethical standpoint that it might be considered a bad company, but there's also its financial
You've also
statements.
got the other way of, could say, famous for kind of not being that. So
Well, its financial statements are ugly as well. So there's like a history since this company went public. Well, sorry, yeah, it's like since it's gone public through SPAC, it's lost like, I don't know, like 98, 99% of its value as a stock. It has
most SPACs have.
Yeah, most SPACs, not all SPACs. There are some that are doing pretty good.
Also,
But
the majority of SPACs are.
yeah. I haven't looked at them all, but I know, like, I don't know. I feel like the whole market's down, but this one in particular, right, is doing quite badly, and it's had some really bad mismanagement. It's had a boatload of debt saddled with it. It's had a lot of dilution through capital raises to keep it afloat. They've tried to pare back all parts of the business, and they're currently trying to sell off Honey Birdette, which was probably the only good part of the business left before they renegotiated this licensing structure. But it's still, in my opinion, a really good value play because it's an asset play. Like, if they do sell off Honey Birdette and sell off all their other assets, like the artwork, and all they're left with is this lean licensing business, no debt, and a potential OnlyFans competitor, then that's an interesting value play. But if you are asking someone like a Munger or a Buffett, they'd say this is a horrible company, this is a bad company. But like you were sort of alluding to, it's where you find these the risk reward. Like, I would say this is a risky investment, but the reward could be enormous. So I think it comes down to your risk tolerance. It comes down to your risk management tools, how much you allocate to it, things like that. So I'm still invested in it, and I've got conviction in it. But if I actually was to grade like the management, they're terrible, and they've been terrible. So yeah, it's an interesting one. I'd say that this is a bad company, undervalued, but has potential to be a good company, and its valuation can revert. So that's my final thoughts on it. But just as
Not
an
to take it even
example,
further, but management is another topic maybe we'll cover one day, and the importance of management and that being a variable that a lot of people put a high amount of weight behind. I need to get better at it because I actually do believe I believe in the thesis. I just don't do it. So it's one of those kind of really
it's
bad things.
it's one of the hardest ones to research. Like, to
Yeah,
research whether a management is good or not. Like, sometimes it's so
but I
opaque and
suspect that it's one of
obscure.
those ones. The harder it is, so it has a massive impact on this. Like, it is one of them ultimate. Like, because I've seen so many companies go down, even at, like, say, my company's level, right, where you're doing, maybe between $20 and $100 million in revenue, and you're not a multi-billion-dollar company, but management even then means so much, and it's so important. The companies that I know that have gone down is from mismanagement largely. Yes, there is global factors, but global factors happen to all the companies, right? And there's companies that navigated it well, and ones that didn't. And I agree with you. I think it's one of the hardest ones to kind of research, but it's one of those ones that, again, I don't know about you, but I haven't put much thought into actually research. It's kind of been like, think about it, too hard basket, don't do it. Whereas I reckon there's a way with modern internets. And just really, really quickly, SPAC performance on the SPAC index. SPAC index fell 75% in 2022 after falling 45% in 2021.
I'm trying to think what some of the good ones are. I know DraftKings is probably one of the one of the better performers of the SPACs. DraftKings, obviously the gambling app and website that's predominantly American based, and sort of leading the charge there to try and get a similar type of system to what you and I are accustomed to, which would be like app-based gambling in Australia. America doesn't have that in every state because the laws change state by state as to what their gambling allows. I know, what's another good one? SoFi. SoFi, which
Well,
is
I mean, Sophie's it's come back a bit. I've got a good mate that invested.
well, SoFi
Fair.
has like if you want to talk about how it's performed, it's come down a lot. But if you're talking about a SPAC that has potential to be like a
Look,
winner,
has potential. I just know a mate that got in. It's returned quite a lot. It's actually actually come back quite significantly recently. It's not back off its highs yet, where it was up like the 20s, but it has rebounded to like 10s. It's come back a bit. Yeah, no, I wouldn't say there's that many.
no, there's definitely some bad ones out there that I could mention as well. Like
Mm.
one anyway. That's enough.
Anyway,
Let's
let's sorry everybody. Me and Arnie can sometimes get into a subject, but subject to actually get into today. I had someone ask me during the week, who listens to the pod and probably listens to my ramblings too much. That basically, for all the doom and gloom going on in the global economy at the moment, and I will talk about the doom and gloom. The markets have held up very, very well, and some people could say that's due to the Magnificent Seven and the rest of it. But let's just say the markets have done quite well this year, especially in the US. Housing hasn't fallen off a cliff in terms of housing prices in Australia. Unemployment hasn't shot up to Great Depression levels like everyone said that it would. Basically, the economy's sticking together quite well. So much so in the US, which we're about 6 months ahead of us rate rises. So much in the US that the Fed is about to double their forecast for GDP, from 1% per quarter to 2% for the upcoming quarter. And then annualized, it's like, you're starting to head towards like 7-8%, where they think it's going to be more like 4 to 5% annualized. But nevertheless, they're talking about that. And you've got strong sales numbers across the board. So, unemployment is up, 3.7 from 3.3 or 3.4 in Australia, and it's up to 3.8 from about 3.1 or 2 in the US. It has climbed, but certainly is nowhere near the kind of the 5% number that is deemed kind of be the happy place in terms of meeting employment needs and having enough kind of openness in the market where it's not so tight. So it doesn't create inflation. So I'm going to quickly just go through a list that I wrote down, and Arnie, please, after I say the list, and anything that you think is relevant. We have the economic issues in the UK. I'm just going to just leave that as like a broad stick.
umbrella.
Yeah, umbrella. I'm not going to go into each individual bit, but China, being obviously Australia's largest trading partners, still got an ongoing trade war outside of kind of Arnold. You got demographics, which is obviously in China, there is a reducing population. So forecasts, when you've got a reducing population and demographic decline in the country, generally the economic performance will be harder and harder to keep in the growth stage because you have less and less people participating. You've had Country Garden most recently miss a debt payment and look like they're in a bit of trouble, which is the largest real estate developer in China. It's bigger than Evergrande. You got the level of worries around their multi-trillion-dollar railroad debt, where 95% of all the railroads, i.e., railroad tracks or routes, actually run at a loss. You got state-level debt problems because they all get their tax income from the sale of property. Largely, that's how they fund their everything they need to do within their state and province. They get a little bit of money from central government, but the majority of it comes from land sales or land leasing, I should say, and with the construction market, the housing market, which has dropped, in some areas only 10-20%, up some areas up to 80%, depending on which city you're in, but an average drop of 30%. You've got exports have dropped year on year 9%. You've got imports that have dropped 7.5%. They were down 14.5 and 12 and a half back in July. So it is kind of improving, but we're still kind of year on year down 9.2 and 7.3. They stopped measuring youth unemployment and so on. So US rates are still 5.33, historically high. We've had some regional banks fail this year. Huge eyes on the commercial property cliff at the moment. $1.2 trillion worth of US debt linked to potentially troubled and highly leveraged commercial property. But 80% of that property is held by regional banks, so not by the big ones. And they're basically scared, which is property prices are commercial property prices on if they're forced to sell, if they can't refinance, are dropping by about 40 to 60% due to the work at home kind of different environment that we see ourselves in now, and less demand. Household savings has dropped to one of the lowest rates in the last 30 years at 3.5%. Australia, we've got the mortgage cliff, supposedly, where 1.1 million homes this year with 500,000 still to go come off low fixed rates on variable rates. We've got lower growth, our dollar's down, which increased the cost of imports. Household saving ratios are down to 3.2%, which is the lowest since June 2008. Oil prices are stagnant and high, around $89 US. And CPI is still hovering around that kind of 4.95%. So, that was a mouthful.
That's a lot of doom and gloom.
That is a lot of doom and gloom. Basically, the world's falling apart.
Yeah, I don't have much to add to that. I know just a few anecdotal things when I was listening to what you were saying. Country Garden in China has had approval to extend their bond payments out, and I think renegotiate the time frame to repay the principal on a lot of them. So not bullish for them by any stretch of the imagination, but maybe we'll avert a crisis there. So that's one interesting.
Just on the Country Garden one, I recommend people reading up about the 100, just to get an idea of the scale of Country Garden.
Yeah.
I recommend people read up about the $100 billion project called Forest City in Malaysia. Yeah, Forest City in Malaysia off the coast of Johor.
Yeah.
Basically, it was supposed to be Country Gardens, one of the big developments. Obviously, $100 billion US is a fair sized development.
Yeah, that's a lot.
When you're talking about it's probably 1/10 of the Australian economy. And it was building a city of 700,000 people on reclaimed land off the coast of Malaysia, right near Singapore. It's supposed to be kind of like a. So just to get if you're on the pod and you're wondering, Country Garden, how big are these companies? Just recommend kind of that's one project, for instance, to go and have a gaze at. But anyway, Arnie, throw it back to you, matey.
No, you're right. Well, I don't have anything to add on the doom and gloom. So basically, you and I are going to talk through the points that you mentioned and the economic, I guess, like the potential catalyst for weakness.
I mean, what are you thinking at the moment? Are you thinking world on fire, but we're just sitting there like that kind of meme with a little dog with a coffee cup in the middle saying it's all fine?
What do I think?
Are you kind of just thinking, hey, look, media loves the negative stuff and we're missing a lot of the positive stuff? And people generally love focusing on the negative rather than the positive. So, we're not good, but we're not bad. Or are you kind of thinking this way, which has got it all kind of wrong? The economy's a lot, a contrarian view of kind of like, we are going to be basically in an ongoing bull market forever, basically.
My personal view on this is that I think we are benefiting from stronger or more resiliency in the US economy than was expected. You mentioned the Magnificent Seven, as they're being started to call them now, and I forget exactly who that is, but it's like FANG plus Tesla and Nvidia or whatever.
Yep.
I think AI as a phenomenon, as a hype, is what has saved American markets. And it's sort of, is that flowing through to the rest of the world? No. Like, I think if you look at every other market, it looks pretty bleak at the moment. I think what I think is going to occur is one, the stronger, the more resilient than expected American market is what is keeping us afloat. But you guys last week with Ash alluded to fixed income and yields and bond yields, and those are rising. So I guess it's sort of like, who do you believe? Do you think it's going to be the bond market that's correct, or or the stock market? The stock market is typically like a forward indicator, but it's not the only indicator. I think the only way we see ourselves in a soft landing or a no landing is if earnings across the board, not just in the Magnificent Seven, continue to rise. Interestingly, there was an article I read from Jamie Dimon, or a quote about what Jamie Dimon said about the American economy, where he sort of thinks that it's not going in a good direction, and people who are being optimistic are making a huge mistake. But that's also off the back of stronger than expected consumer spending in America. So consumer spending, which is roughly about 2/3 or maybe a bit more than 2/3 of US GDP, was up in the latest round of reports, which has sort of forced some of the banks like Goldman Sachs, etc., to raise their GDP forecast by a fair amount. I forget exactly how much, but they raised their GDP forecast up for the quarter and for the year. So where do I think it's going? I think we're going to see rates held for a while. And some people hold the view that that's not true. Some people think they're going to see softening in labor markets, and there's going to be a recession, and we're going to see cuts by next year. I think they're going to try and hold rates there for as long as they possibly can to drain liquidity out of the system, both in America and here and other economies. And it's just going to be a matter of seeing certain economies give into the pressure. So we saw recently that Poland cut interest rates by 0.75 basis points, and they've got 10% inflation. So they've sort of capitulated. Some people are saying, is that because there's an election coming up there? Possibly. We are not. I don't think I think we are a strong economy, albeit a limited one. So I don't think we'll cut anytime soon. I think we'll wait for America to do a cut before we try and follow suit.
There is word though that America is going to be, due to the stronger performance of the GDP and growth and sales and all the rest of it, that America is going to delay their expected cut. Interesting one just on the US spending. We keep talking about that resilience. I just quickly share. I was just interested in what is current credit card debt. This goes all the way back to 2004. That's where credit card debt currently is, which isn't surprising to me.
So that's 1 trillion USD for people who aren't watching, and that's the highest. That's the highest it's been since 2004. Previous peaks were at the start of 2020. It looks like, and it got to about 900 and something billion.
Yeah, 900 billion, and then it dropped down to, we paid off our credit card debt during COVID. It looks like down to about 750 billion. So it dropped to about 200 billion, and then it's shot up in the last 2 years and directly straight line up basically to about about 1 trillion and 50 billion.
Yeah,
and
it looks like previous peak was way back when
2008, just before the GFC, at 860 billion, and it dropped all the way down to about 650 billion. So large climb there, and I had a look at a couple other ones really quickly.
Well, I was about to say,
balance on auto loans.
Yep. So auto loans has gone straight up. So since 2012, where it was sitting at, what's that, half
650 billion.
Well, it was
gone to 1.6 trillion, so it's tripled nearly.
Three times in auto. That's auto loan debt, and obviously people at home wondering what the significance of this is. It's probably because when there's something like a loan like this, similar to 2008, although not to the same quantum, these auto loans would be collateralized and sold off. And if people default on them, and large numbers of people default on them and can't repay them, then it's going to have a knock-on effect or a contagion effect where lenders or businesses who are expecting that payment and that money to come in don't get it, and then can't service their own debt obligations, and it has a huge domino effect. Will 1.6 trillion auto market be enough to trigger that? I don't know. As opposed to the housing or the mortgages, which Brad's just pulled up, which is interesting data.
Yeah, the mortgages was an interesting one where, like, obviously 2004 were at about 5 trillion, sorry. 2008 before the crash got up to about just over 9 trillion, crashed down to eight, and then has kind of gone up to 12. And I mean, in 2020, it was still down at 9.75. And kind of gone up to 12 in recent years. When really the housing, from my opinion, housing hasn't jumped necessarily in growth in the US market, especially in 2022 and 2023. So it's interesting that debt balances have continued to go up. Which
Yeah,
means
well,
more people could just be more people taking out loans and buying houses at that point.
and this is
Um,
purely retail balances we're looking at here. Like, there's obviously the other
Correct.
commercial real estate market, which you and I and Joel have touched on previously, and that is a large market where there's also some pain being felt because they're directly affected by the rate rises, as opposed to the American consumer, who can, in most cases, lock in their mortgage for 30 years or whatever it is at a fixed rate. The commercial guys are feeling it when it's variable. So
Yep. And the last one, just to share. Give me 1 second. Just on share. New share and throw over this one. Um, and this is just economic data on what we're looking at the moment is delinquency rates on car loans. Oh, sorry, credit card loans. And so whilst it is higher and it has sharply jumped up from around 1.5 to 3%, which is about a doubling over the last year from 2022. Credit card debt peaked, before the GFC was 3.5%, so still higher than where we are today. And it actually peaked at about 7%. So whilst there is a strong kind of, how to say it, uptick in credit card delinquency, and it may be something to watch out for. It certainly is something that is still well below, I guess, on like previous rates. And then on single family residential mortgages, delinquency rates are very, very low. We're sitting at like below 2.5%. It's basically the historic kind of mean, I would say, over the last 30 years. Looking at that graph there, Arnie.
yeah, it's
So it's interesting. It's interesting to kind of track all this stuff and have a look at some stuff. But just thought I'd bring that out with the new sales, especially around credit card debt.
no. Thanks for sharing that. It paints
fueling.
It paints a bleak picture, doesn't it? I think you asked me before, how do I think it's going to go? I think we're going to see some pain, and I think when one of those dominoes fall, the other dominoes are going to fall, and we're going to see a crash. So, am I being cautious with investing and in equities markets? Absolutely. If I want to reposition myself, I'd be looking at alternative asset classes at the moment, or sitting on cash ready for a crash. And it's all about your allocation. But having said that, if I see a company I like valued, if it's undervalued, and we talked about at the start of this podcast, the different metrics I might look at, and if it ticks all the boxes, I'm not going to shy away from investing in it, because if it's undervalued now and it goes through a period of a crash, then I'll just buy more of it if it ticks every box.
Gotcha. No, look, I'm pretty much the same as you are, which is, we said this a bit. I think US resiliency of the market has been the thing that has stopped, I guess, the world imploding economically. However, I think that a lot of that is not necessarily fueled by real strength. So some of it is real strength. AI obviously coming in and helping out. Do I believe that AI should have added 30% to the market? No.
No, in real terms, it's not making
right
an addition.
now,
It's only hot.
and the stock market is forward looking, right? So it's not exactly now either. It's trying to predict what's coming up. So
it's a funny way to think about it, because it's pumped asset prices up. That has given people more comfort in their collateral. So it is having a real effect. But you're saying, is there a throughput yet from AI into the economy? The answer is no. Well, maybe limited.
No, very minimal, very minimal. So that's one thing. I think with the debt rates up, I think people are starting to. I just know from my early 20s when cash was hard to come by. You drain the bank accounts, you start borrowing from parents and borrowing from wherever you can to pay up for your loans. And at the time I had nice car loans. And then you start taking out credit cards and you start using credit cards to pay for things. And I think I always personally believe that credit cards. I think people underestimate how much people who are struggling look at credit cards as their kind of way out,
as
or their
their
way
answer.
of financing, as their answer. I've been
And
there, so
and if you can't get one, credit standards are tightening. So,
and then that's what ends up happening is you rack up credit card debt to a certain bit, and you can't roll it over. You hear the words, "No, sorry, your debt balance is too high. We're not going to roll it over," and you think, I was literally relying on being able to roll it over and get an interest-free period on it. I can't anymore. I'm done. And so I think what's going to happen is those delinquency rates that we've started seeing go up are going to keep going up. And I think we're going to start seeing some pain in 2024. And then depending on China's a funny one to actually I think China's nearly impossible to guess what's going to happen. It doesn't function like a free market. So we can all think this is what should happen in economics, but it's not. It doesn't function on.
Yeah, it's not the same as the Western economy.
So I'm not even going to try and guess what's going to happen there. It could go as far as rebounding and being like a powerhouse to being the ex-Soviet Union. Don't know. But I will comment about kind of Western society and say that if, I think we've got to get some stuff in check. I think 2024 is going to be pain. That doesn't mean like jump out of the markets or like short the whole thing like Burry does. But it probably does mean looking at where else you can get, looking at your portfolio and saying at the moment, for instance, I'm looking at putting, allocating a large proportion of my portfolio, general nature, all that kind of stuff to your due diligence into fixed income. Because for me, especially kind of, post Hamatech sale over the next couple of months, when I say sale, I mean kind of sale of some secondary of mine. Don't mean sell the company. Earning 5 to 8% of my money is a nice thing, and I don't need to chase too much higher returns than that. So it's a personal situation, and but I'm definitely looking at some fixed income to bring into the portfolio at the moment. As you said, still looking for those value stocks. But I think they're going to be harder and harder to find, and I'm going to be waiting on hopefully buy some property towards the back end of next year. Hopefully, a little distressed assets, but hopefully not too bad for the people out there. But yeah, that's kind of where I am at the moment, and where I think it was a good question because there is a lot of doom and gloom out there, and there's a lot of people saying, "Well, all this stuff, the world's supposed to have crashed and it hasn't. So how much credit is there, in all these indicators and in economic theory, and has things changed and moved on from Keynesian and inflation being and monetary policy being the key things and all the rest of it? Yeah, somewhat, but I still think there's a lot of benefit in economics and.
Sorry to cut you off, but the big spectre on the horizon is one we've also previously discussed. Haven't really touched on it a lot in this particular pod, but we're seeing, I know there's certain signs in the American economy, even though we mentioned some of the strength in spending, there's also a lot of signs of reinflation and supply side costs and input costs rising. So if people are, negotiating pay rises because of these record profits that are coming in because of inflation, but then we see a reinflation and a wage price spiral, they might enter a stagflationary period where they're seeing
doom loop.
Yeah, exactly. So it's going to be interesting to see what happens there.
Watch this space, basically. I think Arnie is a key way of saying it. If you do have that real wage growth in conjunction with high amounts of debt and spending, in conjunction with high we've had sustained higher oil prices for a while, and they're only going up. And you got the Saudis and that confirming they're not going to. They're going to cut again until 2025. They're loving the oil prices being this high. I mean, you add in oil prices near $100 US. You remember, like during the kind of the bad oil times, it was up at what 140, I think it was, and that
Yep.
was during the GFC around there, and it was basically like end of the world, like inflation's because oil has a flow-on effect to everybody. We've covered it once, but oil has a flow-on effect to basically everything. It makes so much stuff like plastics and chemicals and fertilizers and asphalt
And jet fuel
yeah,
and
jet fuel,
transport.
and boating fuel, and crude. Like it's everywhere in society. It's not just in the car. It also adds to the logistics. So every product that's shipped around the world is either shipped around the world, put on railway, or put on trucks generally for the last mile, or more than last mile, but call it last mile. Outside of rail, both ships and trucks all use oil. And there's a huge input cost. So that's the largest variable generally cost of running those operations. So when oil's at a sustained high, and Biden's just cancelled as of this morning drilling in the Arctic and around Alaska. So just kind of as Arnie said, watch. My thing would be just watch for reinflation. And the war's not over. We always forget that we've still got a freaking war going on in Europe. I'll just say tread carefully. And look, maybe there is a little bit too much alarmist and we don't look at all the great stuff. But at the same time, I wouldn't say there's too many, from my opinion, too many green sprouts.
I don't think so.
To rush into the market at the moment. I think it's more of a wait and see.
Well, on that note, sorry for the doom and gloom pod, but it does, it's the way of the world. Do you want me to hit you with some rapid fires and then we'll do a...
Rapid fires, Arnie.
I got a little 50-50 in my head that I have.
By the way, that wasn't all doom and gloom, mate. We got, we talked about the other view, but you're about to go to the doom and gloom.
Well, 50-50 isn't necessarily rainbows and unicorns today. So here's 50-50. So BP chief Bernard Looney has resigned over past relationships with colleagues. So I don't know. That's probably not. I don't know if that's bullish or it's probably bearish for BP. European Central Bank has said that the new 2024 inflation projection is to be above 3% versus 3% in June, which is firming the case for an interest rate hike in the Eurozone. They've said that their growth projections in the Eurozone for 2023 and 2024 are broadly in line with what the market expectations are. Oracle has sunk 14% in its biggest one-day drop since March 2002, which is the famous ERP software. S&P 500 is
Oracle dropped 14% in
one day. Yep, that was a couple of days ago. So the ticker is ORCL if you want to have a look, tankers. S&P 500 has closed down 0.6% and the NASDAQ 100 fell 1.1%. Double Lines Capital Gundlach has said the Fed he thinks the Fed cuts in the first half of next year. He said they're absolutely looking for a recession next year. He says we've had enough economic weakness for the Fed to be done hiking. And he said the Fed wants the economy to slow quickly and rates to go down. So that's his view. And he's probably right, but whether or not that happens or not, that's the other question. Apple's iPhone event has concluded and they have priced the 15 Pro Max at $1,199 US. The iPhone 15 will be $799 US and the iPhone 15 Plus will be $899 US. And Apple is down 2.1%. So a little while, and that's my rapid fire. You and I were talking about waiting to see weakness in Apple before the market would come down. This is prior to the AI Magnificent Seven pump of the market. So, yeah, Apple's still got good cash flow. Interested to see what happens there. But yeah, that's 50. That's rapid fire, bro. But I got an interesting 50-50 for you.
Boom. Throw it.
If you had to choose a flavor of milkshake, and I only had two options: chocolate or strawberry.
Yep,
what are you choosing?
Strawberry. Strong strawberry every day.
Me too. Strawberry every day. I feel like the strawberry milkshake is like just hits different than the other ones, especially if it's
now.
malted.
If you throw banana, like not banana flavoring, but a banana strawberry smoothies.
Ooh,
Primo.
okay, yeah. I
But if we're
like
going
it.
milkshakes, just strawberry. I mean, nothing beats it.
That's it. That's it. Well,
Like vanilla comes close, but chocolate very far behind.
just a simple, easy 50-50, just
Easy
highlighting that,
50-50 today for every
consensus.
sometimes things can be nice and simple.
Well, they should be. And that's one of the joys in life, isn't it? It's just like also we do the 50-50 to highlight that there's choices in life as an
That's what I
investment.
mean. They're not always hard choices.
No,
Sometimes.
sometimes it's a slam dunk for you and me. It's strawberry all
Sometimes
day.
a slam dunk. Indeed, there's some shares that are slam dunks, mate. It is what it is.
Oh, general in nature, but just to throw it in at the end of the pod here, Intel on the rise. So happy to see that. I think that one's going to keep going.
What's interesting, I think the Intel rise is largely off people not being able to
Off
get
AI.
NVIDIA. Yeah, not being, but also not being able to get any of the NVIDIA chips and
It's
so many
Nvidia.
projects.
It's Nvidia, but it's also the fact that they're going to be the foundry of choice for the Western world, and they've been positioning that way. And I think people are starting to realize that the geopolitical tensions are going to have a big important
There is
factor.
100% that. I think
Yeah.
it's also like their quick $1 billion or $2 billion worth of sale of their Gaudi AI, which is kind of the lesser man of the NVIDIA A100s. And
Something we forgot to talk about, which might be interesting for the next pod, is ARM is IPOing. We could talk about that.
Yeah, let's talk about that next because I actually had breakfast on Saturday with a guy, ex SoftBank guy, and discussing all things ARM. So it was quite interesting how they're packaging, how Mastodon is packaging that one up. It's packaging it up, mate. It's
I
quite
like it, bro.
interesting. So let's and I'll create. It was funny because we're talking about how much estimates we all think that's going to make. And I said they'll probably bring him back up to positive just after
funny.
losing 50 bill. Anyway, we'll talk about that one next time. Arm. Interesting times.
If you want to get us at Money,
You know what? I'll even try and get him on the. I'll ask maybe if he wants to come on the pod.
Yeah, get him on the pod, and we got to get Vin back on. Meant to have Vin on last week. Sorry, Vin, if you're listening, I got to get in contact with you.
He's just got a role as head of M&A for Asia for Microsoft, and so we could probably bring him on the pod and just talk about bring him on as like a bit of an ARM expert. Where he's not allowed, obviously, he won't be able to disclose anything that he's not public in nature, but at least we'll have a specialist on the.
Well, he could just give us a good overview because I think ARM. I mean, it's exciting. There's hype, but there's a lot of stuff that would be public that we just don't even know about because we're not as close to it. So,
100%.
If you want to get us at Money in the Tank on YouTube, Instagram, Facebook, and X, and leave a like, comment, subscribe, click the bell.
Love it.
Thanks for joining us, Tankers. Cheers, Braddles.
Cheers, mate, and see you tankers later.